This is tutorial number 2 in the Beyond Fibonacci Retracement series, where we're going to learn about more ways to use alternate price projections to identify support, resistance, and trend reversal targets in advance. So let's get started by talking to Bob Miner, founder and president of Dynamic Traders Group.
Hello, I'm Robert Miner, the founder of Dynamic Traders Group, and welcome to our price tutorial. This tutorial we call Beyond Fib Retracements, how to use external alternate price projections with retracements to identify in advance support, resistance, and trend reversal. You're going to learn one of our unique dynamic trading price projection techniques where we look at two different price projection techniques to identify very narrow range price target zones for trend reversal. And of course, as everything we teach with dynamic trading, we teach it from a very practical standpoint, and what we teach can be used with any market and any time frame. So let's get started and learn what a external alternate price projection is and how we use it with retracements to identify these narrow range price target zones. Before we get started with the educational part of this tutorial, I just wanted to show you how Dynamic Trader does the retracements and alternate price projections on the chart, because you're going to see me doing that a lot, and it's better that I show you that ahead of time so we can move quickly through the tutorial section. Now, if you took the number one tutorial in this price series, I explained this in that tutorial, but I'm just going to take about 1 minute to show you, just in case you didn't take part 1 of the series. Up along the top of the software, these are the retracement and alternate price projection icons and the price expansion icons. So you can right click in either one of these icons, excuse me, and the menu will come up where you can choose which ratios you want to use for your retracements and what the color of the line should be and whether they should be thick and thin. Now, for the most part, we'll be looking at 38, 50, 62, and 78.6% retracements, and all of the retracements are going to be in blue. That's so you can easily identify them on the chart and distinguish them from the alternate price projections. And the 50, 62, and 78.6% are thick lines instead of thin lines, and we explained those ratios and why they're thick or thin in the first tutorial of this series. Now, you do also have the choice to do the retracements by range or percentage change, and to do them from the high or low of the bar or from the closes. And then we can display the results in several different ways with the labels on and show the projection lines and reference lines. And of course, for this tutorial, we show all that information. So once we have the ratios chosen that we want to use, we can just go OK. We'll click on the icon, and we click from the low bar to the high bar, and all the retracements are done. And once again, all the retracements will be in blue. And you can see that we display the information very clearly. This is the exact retracement level, and then it tells you what type of price projection it is. In this case, a retracement. So we have RET, and then the exact ratio that we do for the retracement. And then you also see me erasing lines frequently. We can also do something like we just click on one line and say keep me, and it erases all the other lines, just like we did there. Well, how about the alternate price projections? They're done about the same way. We can right click on the icon. We can choose what ratios we want to use. We can add any new ratios in we want if they're not one of the defaults. And in this case for the tutorial, all of the alternate price projections will be red. And for the most part, we're going to be looking at the 100% alternate price projection for this tutorial. So once we've made our choices and we got it set up how we want to display it, then we just click from high to low, and then the third point, and in this case, the 100% alternate price projection is made. So that's how we'll be doing it throughout this tutorial. I want to show you just one other thing. You'll often see me right-click on a little tab that's near the retracement or alternate price projection icon, and it brings down a little drop-down menu. These are all different sets of ratios used in different circumstances. For this tutorial, we'll be using the dynamic retracements, which are also the internal retracements, and you learn the difference between internal and external in part 1 of this series. And another part of this series, you'll learn about external retracements and the end of wave retracements as well. Those are just different sets. And in the alternate price projections, oops, I clicked on the menu and not the little tab there, we have different sets also. In these, I've just labeled 100% and the 100, 162, and then the 3 main ones we use for the internal alternate price projections, 62, 1, and 162. So that's just to explain to you how we do the retracements and alternate price projections in Dynamic Trader, so that as we go through the tutorial, I don't have to explain what I'm doing. You'll just see me click on the retracement icons, and they'll all be set up for the right colors and the right lines and how it's displayed. So let's continue on with the learning portion and learn all about alternate price projections and retracements and the differences between internal and external alternate price projections.
Let's begin with a review of internal alternate price projections. In the first tutorial in this series, you learned about internal alternate price projections. Let's quickly review how we make internal APPs, and then you'll learn how to use external APPs. So to get started, internal APPs are made from swings made after the extreme of the retracement range. They can be made if there are nice, well-defined swings since the extreme of the last retracement range. And they're made in advance to help identify which retracement is most likely to be support, resistance, or trend change.
In part 1 of this price series of tutorials, we taught you how to use the alternate price projections to help identify in advance which retracement level was most likely to be support, resistance, or trend reversal. And we taught you how to use the internal APPs, our alternate price projections, to identify those retracement levels in advance. Now, what do I mean by internal APPs? We're going to have a little bit of a review here just for this first example, so we can see different ways that we use the APPs to identify support and resistance. Well, internal APPs are made from swings that are made within the range of the retracement. So we have a high that's on the left of this chart. We come down to a low. The market then made a sharp rally, a decline, and then a sharp rally. And as of the last bar on the chart, it's taken out that first swing high. So the internal retracements are made from the swings that are made from the low that we're making the retracements from. So let's just do one of these. Let's first do the retracements from the high to the low. And we can take off the 38 and we can take off the 50 because we're already above that. So what we're concerned with is the 62% and the 78.6%. And our job now is to identify which one of these retracement levels is most likely to be resistance if this market continues higher and if it's making a correction. Is it likely to be the 62% or the 78.6%? So we can do our internal alternate price projections, and we do those by measuring from the low where the retracements began to the first swing high, and then making the projections from the next swing low. So we've measured the range of the first rally, and then we've multiplied that range by our ratios and made the alternate price projections from the second low. Now that's what you learned in part 1 of this course. And as you know, we can use any market, any time frame. So of the two retracement levels, which one is most likely to be resistance if this market continues to advance? The 62% or the 78.6%? Well, most likely the target is going to be around the 78.6%, not the 62%, because the 100% alternate price projection is very near the 78.6%, and there's no alternate price projections near the 62% retracement. And of course, this 162% alternate price projection is well above where the retracement range began, so we can just eliminate it. And let's just even eliminate the 62%. Here's our whole focus for high probability resistance zone if this market advances and if it's making a correction or a retracement to this range. So we know that in advance, and of course that's the beauty of everything we teach in dynamic trading strategies, is we identify in advance support and resistance levels where we're likely to have trend reversal. So let's add a couple bars onto this chart. There we go. I added one more bar, and we came up, popped above this zone that's the 78.6% retracement and the 100% alternate price projection, went right through the 50%. And if this market is making a correction, this is the area to which it should make resistance before it continues lower. We can add a few more bars on, and we see they came down rather sharply from this resistance zone. So we identified that zone in advance by making our retracements and then our internal alternate price projections that identified which retracement level was most likely to be resistance. And of course that retracement level, I'm going to go ahead and put these back on so we can see where that 50% was again. Let me just erase those, or not the 50%, but the 62%. We can see that this level is quite a bit higher than the 62% retracement level. So don't you think that would be helpful in your trading to be able to identify in advance that the market was not likely to find resistance around the 62, and it was very likely to find resistance if it came up around the 78.6%, because that's where the alternate price projection was. So that alone is very valuable information. So now what we want to look at and to learn is, what if we don't have some nice clean swings like we did in this example? We had this nice swing up from where we began the retracements at this low, then we had a decline, nice well-defined decline, then another swing up, and we were able to measure this first swing up and do the alternate price projections from the second low. But what if we don't have these nice swings and it's very choppy in that sort of situations? Can we still use alternate price projections, and how do we use them? And the answer is yes. Now let's learn how to use them.
Okay, let's talk about external alternate price projections. External APPs are made from swings that are outside the retracement zone. They're always made when there are no obvious swings to make internal APPs from. The most important ratio for external APPs is 100%. Support, resistance, and trend reversal is often made near the retracement where the 100% external alternate price projection falls.
Well, this is 5-minute S&P data. Let's take a look at it and see how we can use what we call the external alternate price projections to help us identify resistance retracement levels. So as of the last bar on this chart, the S&P had a gap opening down, and it's making a rally up. And let's assume our higher time frame analysis and trend analysis indicates that the market should continue lower, and it's making a correction to this gap down. And we want to identify the highest probability resistance zone where this correction is going to end. So first, let's put the retracements on the chart. There we have all of our key dynamic retracements. We can just take the 32% off. As of the last bar, it's popped up early in that day, right around the 50% retracement, 60, and then we have the 62, and we have the 78.6% retracement. Well, Which one is it likely to find resistance if it's making a correction? Well, the rally up is pretty much straight out, just 1 or 2 bar little declines. Hasn't at least yet made any nice, well-defined swings to make internal alternate price projections from, and it's already above the 50% retracement. So if we don't have some nice, clean internal swings to make alternate price projections from, where do we make them from? Well, we do what we call external alternate price projections. And we make them from rallies that happened outside of this retracement zone. Remember, the internal retracements were made in the swings made within the retracement zone. Now we're going to go outside the retracement zone, and we're going to make alternate price projection of swings outside the retracement zone. So let me click on the retracements. And usually when we do external retracements, we're primarily looking at the 100% alternate price projection. So I'm going to measure the range of that swing, and I'm going to make the projection from the low where the retracement began. I'm going to measure the range of this swing right before our retracement zone. And let's see what we have. Let's get the chart cleaned up a bit. So we've made the 100% alternate price projection of this swing up that was made back a day or two before, and then for the swing up that was made the day before, and we're making those projections from the low made so far the current day. And where do these projections fall? Well, they surround the 62% retracement. So they're closest, both of them are closest to the 62%, not the 50, not the 78.6%. So more than likely, if this market is making a corrective rally, it's going to find its resistance right in this zone of the 200% alternate price projections which surround the 62% retracement. So we can even take off the 50 and 78.6%. I'm just going to clean the chart up a little bit here. So now we have in advance the high probability retracement resistance zone to which ought to end this correction to the decline that began from the gap opening on this day. And this example, by the way, is only a day or two old. So it's very current, and every day we see these examples. Well, let's add some bars on the chart. Ooh, the next bar poked right above our high probability resistance zone, which is right around the 62% retracement. And let's add some more bars. We'll keep adding quite a few more. Well, we can already see that's the exact area to where this market completed its correction. I'll add some more bars, and later in the day the market went on to make a new low. Now, how valuable do you think that would be to you to identify in advance which retracement was likely to be the resistance zone of where the counter trend or the correction was likely to end? Well, it's very valuable whether you're a day trader or a swing trader or a position trader. Now, I'm going to put the other retracements back on the chart just so we can see where they were. And of course, we were already above the 38. And here was the 50 that, when we began this example, was just a little bit above it. And here's the 78.6%. So, but we identified in advance right around this 100% alternate price projection and 62% retracement had the highest probability of being resistance. Not all the way up at the 78.6%, not down here. So I'm going to erase at the 50%. I'm going to erase those again. And yes, it did pop above it for one bar and then came back down. It would be nice if we could precisely identify the exact resistance and trend reversal zone every time, but we're not going to be able to, but we are going to be able to identify the vast majority of the times around which retracement is likely to be support, resistance, and trend reversal. And of course, I'm emphasizing we do this all in advance, so we're prepared in advance. So this is an example where this market was shooting straight up, and we use the external alternate price projections to identify which retracement level had the highest probability of being resistance in this case and ending the corrective rally. Let's look at some other examples.
All right, now let's take a look at how external alternate price projections relate to retracement levels. External alternate price projections help identify in advance which retracement is most likely to be support, resistance, or trend reversal. If a retracement does not have one or more internal or external alternate price projections near it, it's not likely to be support, resistance, or trend reversal. Now, with our approach, we use tools and techniques that identify in advance high probability support, resistance, and trend reversal price zones. Alternate price projection and retracement zones will not always pinpoint the exact trend reversal, but will usually indicate in advance the minimum and maximum target for a correction.
Well, this is bond 60-minute data. And let's see how we would use our external APPs to identify resistance retracement levels. So bonds have been in a strong bear trend for several weeks as of the end of the data on this chart. And as of the low on this chart, it's making a real kind of choppy advance, not that nice clean swing up, one down, another one swing up, that we can make a internal or well-defined internal alternate price projection. So let's make some external alternate price projections and identify which retracement level is most likely to be resistance if this market is making a correction and going to continue its bear trend. Well, I've just put the retracement levels on from the high to the low. We're looking for it to retrace this section down, and more than likely, if it's making a counter trend rally as we anticipate, it's going to make its counter trend or corrective high around one of the retracement levels. So let's do our external alternate price projection. And we'll do it from the most recent, oops, I didn't quite click on the low bar there. We'll do it from the most recent external swing up. And again, we mean by external swing up is a swing that was prior to the retracement range. So it was that rally just before we began this retracement range. And we have that alternate price projection falls around the 62% retracement, just below it. Now let's do the 2 or 3 more external, not retracements, but alternate price projections. And then we'll see how we use them all to find a little zone that's going to give us the high probability target for the counter trend high. So I've gone back and done the alternate price projection from these other 2 corrective rallies. So now we've done it from 4 back, the most recent, 2nd back, 3rd, and 4th back. Now, the one that's the alternate price projection is well above the 78.6% is probably irrelevant if this market is making a correction, because it's well above the 78.6% retracement. And as you learned in the first session of this tutorial series, a correction generally doesn't exceed the 78.6% retracement. So I've just erased we'll call it the outlier. And then we have the other 3 external alternate price projections, and they're grouped right in between the 50% and 62%. Well, let's focus down. I'm just going to take that 78.6% retracement off. I'm going to bring our data up so we can see these a little bit better. I'll clean the chart up again a little bit, get rid of that 38%. So, is around the 50% or around the 62% most likely to be the resistance and the end of this corrective rally based on the 3 external APPs that we did? Well, they all fall below the 62%, and 2 of them are within just 2 ticks of the 50% retracement. So more than likely, if this market's making a rally, if it's making a correction, more than likely its corrective high is going to be below the 62% retracement and somewhere very close to the 50% retracement, because we have this great retracement and alternate price projection zone just within a few ticks. And this is just a 3-tick range that we have 2 of the APPs and the 50%. So we've identified in advance that more than likely, if the market is making a corrective rally, it'll make its corrective high right around the 50% retracement, more likely than the 62%. So let's add some bars on the chart. Oh boy, the next bar is a big wide range up, right into our zone of alternate price projections of 50% retracement. I'm going to add some more bars. Declining, went right back up to test it, right to the tick, and chopping down a bit. And as of that last bar on the chart, made a new low, and look where the corrective high was. Exactly where we had identified it in advance near the 50% retracement. Now, how valuable do you think that is, whether you're a day trader, swing trader, or position trader? And once again, I want to identify that we identified the high probability retracement in advance. So we would be using our other tools such as our momentum oscillators and pattern analysis. Once the market hit that retracement level, we'd use those as part of our trade strategy and our practical trade techniques, which we'll be teaching you in another tutorial. Right now we're just focusing on price and identifying in advance the high probability targets to complete corrections or trends. Let's look at some more examples because this applies to every market, every time frame.
Okay, let's take a look at how we identify price targets for corrections in advance for all markets and all time frames. Remember, our approach is used by all types of traders, long-term stock position traders, Forex day traders, and every type of trader in between. The objective of this approach is to identify the high probability retracement target to complete a correction against a trend in order to enter a trade in the direction of a trend. Now, as a trader, you should use some trend filter to identify the trend direction. One of the best ones that we use is called the dynamic trend filter. Using the external APP will help identify the maximum target for a correction.
Well, let's look at a couple examples with ETFs and sector ETFs. We follow those in our report all the time, and they're great trading vehicles along with stocks. But this is the technology ETF. XLK is the symbol, and it's 60-minute data. And it's been in a strong bull trend during the period of this data. And I just put the dynamic trend filter indicator below the chart. We're not going to go into momentum and trend indicators in this tutorial series, but I just wanted to put it on to show that the green positive lines indicate that it's in a bull trend and that any corrections or any declines are likely to be corrections in the bull trend. So our objective is to look for a minor retracement to which we can then position ourselves long. And we want to see if any of the alternate price projections reinforce the retracement levels. Well, let me put the retracement levels on first of this most recent little swing. Get some of that data back up on the chart. And as of the last bar on the chart, it's hit the 50% retracement. So I'm just going to take that 38.2% off. And I realize there's not much distance between the 50 and even the 78.6% for that matter, but we want to look at some of the external retracements and see if they're going to help us identify where a minor corrective low might be. So we're going to measure the last little correction and project the alternate price projection from the beginning of the current retracement zone, and that falls just a tick or two above the 50% retracement. Let's go back to the second external alternate price projection, measure it, and project it from the high. It looks like it overlaps the 62%. Now, these were the most two recent corrections since this larger time frame correction back several weeks ago. So, more than likely, since the trend is positive, the market is making a minor correction, and it should be in some symmetry to the prior minor corrections. Let me focus in just on the most recent data here. So we have a retracement zone, and I'll go ahead and label these from the November 10th low into the November 15th high. And we have one of the alternate price projections falls right near the 50% and one near the 62%. So we don't have them in a tight range. So will this corrective low end around the 50 or 62? Well, it could be either one of them. What we do know from doing these external APPs is more than likely it won't go beyond the 62% retracement. So as of this bar in the chart, and by the way, the reason these bars change colors is they change colors on alternating days, so you can tell when the intraday data changes from day to day. So for instance, this really wide range bar, which is the first blue bar of the next blue bar series, would be the first 60-minute bar of that day. So that tagged just below the 50% retracement. Because the alternate price projections fall near both the 50 and 62, the corrective low could be made near either, but more than likely, and this is the key piece of information, more than likely it's not going to exceed the 62% retracement. So as of the last bar in this chart, which is near the end of this day, the last 60-minute bar, we know that more than likely this market is not going to decline below about 2097 before it's going to continue on its bull trend. And that's a very valuable piece of information. Yeah, it would be nice if both of these alternate price projections fell right near one of the two retracement levels, but isn't it nice to know in advance that this is probably the limit of this little correction within the bull trend, and then the market's going to continue on to a new high? That's real valuable information, practical information that you can use as part of your trading strategies. I'm going to go and I added some data on, and the market continued up very strongly, and it's made its corrective low right in between the 50 and 62%, of which the external alternate price projections indicated that would be the maximum retracement for this correction within the bull trend. And this brings a good point to mind, is that when the stronger the trend and when you have just these minor corrections within the trend, this is when these external alternate price projections become very valuable, because in strong trends, the corrections tend to be symmetrical with prior minor corrections. So that's why we do the alternate price projections from 2 and 3 and sometimes even 4 of the minor corrections prior to where the current correction is being made. So very valuable information that we identified in advance that this was probably around the 62%, the maximum that the correction would be before this bull trend continued, by doing the external retracements of the prior minor corrections. Let's look at another ETF. This is IYR sector ETF, and we follow this quite a bit in our reports. As of the last bar on this chart, the market has been making a choppy advance. And let's assume that our higher time frame trend analysis indicates that the bull trend is going to continue. We're looking for a spot which would make a corrective low. Now this is daily data, and these corrections are only 1, 2, 3 bars of daily data, so you don't have to have the intraday data to do these retracements and alternate price projections. So I'm going to do the retracement of this most recent swing up, and we see we had a big gap down, and as of the last bar, daily bar in the chart, it tagged exactly the 78.6% retracement. So we've already passed through the other retracement levels. Let's see if there's some external alternate price projections that fall near that would give us some symmetrical support. Oh boy, the alternate price projection of the last minor decline is within about 1 or 2 ticks of the 78.6% retracement. How about the one before? And it's falling right on top of it. These are very symmetrical little corrections in this bull trend. So as of the last bar in this chart, what do we know? Well, the market has come down and tagged the 78.6% retracement, which is just within ticks of the prior two external alternate price projections. So if this market is making a correction, then as of the last bar in the chart, that should be the low of the correction. And even though it was a big gap down day and it closed lower, if we're just looking at closing data, it looked pretty negative, we know as of this day, this market's in a position for a buy if our trend analysis is indicating that it's still in a bull trend. And what a great setup it is. We're right near what should be the extreme of the minor correction, and most traders are going to look at a day like this and say, oh man, that's a gap down, it left the gap, closed lower, closed below the open, this is a very negative day. But we're going to know, because of our retracement and alternate price projection analysis, that more than likely that day is the completion of a corrective low and the market's going to continue to advance. So let's add some bars. There's 2 or 3 more days it came down to test that low exactly. Oh boy, were we right about this? Add another bar, it's coming back down, and we add some more bars, and there the market takes off. Again, we were looking for the ideal place to complete a corrective low and a bull trend. We identified in advance as of this bar that bar was probably at the extreme for a corrective low, so in an ideal position to position long for a continuation of the bull trend. So what a great piece of information that was, that we were able to look at the market in advance. We didn't need intraday data. We did it just on daily data, and it worked out just perfectly. So we've looked at a couple ETFs. Let's look at some stocks and see how this works.
Let's take a look at using external APPs with some stock examples. Now remember, all of our dynamic trading strategies apply to all markets and all time frames. We can usually identify the high probability price targets where a market will complete a correction and continue the trend using this approach. Corrections now are often very symmetrical and end near the 100% external alternate price projection. The most frequent price zone where a correction will end includes one of the dynamic retracements and 100% external alternate price projections. Let's take a look.
Let's take a look at some stock examples. Everything that we're teaching you can be used with any market and any time frame, whether it's futures, ETFs, Forex, stocks, whatever. It's all applicable to all markets, all time frames. Well, let's take a look at this is Alcoa stock, and it's in a pretty strong bear trend. And let's look for what would be the high probability retracement to complete a correction and then continue on with the bear trend. So we put our retracements on from the high to the low. And as of the last bar on the chart, it's reached the 50% retracement. Well, should that be the end of the correction? We've got pretty sloppy sort of, well, it's a pretty strong uptrend, not sloppy, but a strong uptrend, and no real well-defined corrections that we can make the internal alternate price projections from. So let's go and compare it to the last corrective rally and do the alternate price projection from the last corrective rally and see if that falls near one of the retracement levels. Well, let's take away the ones below the market. So here's the 50% retracement where the market is at now. And then at the 62% retracement, just a couple ticks above it, is the 100% alternate price projection of the last correction, kind of major correction, falling right near the 62%. There's no alternate price projections falling near the 78.6%, and the 162% is above the retracement range, so we can just get rid of it. So more than likely, if this market is making a correction as we anticipate, and we're looking for an area to enter a short position at a corrective high, or if we happen to have been long from around where the low is, an area where we'd want to take profits on a long position, it would be right around the 62% retracement. Not the 50%, not the 78.6%, but the 62%. So let's add some data onto this chart. And it's really hovering around that 50%. And there we have a big gap up day right into our little retracement alternate price projection zone. Boy, and that looks very positive. Gap up day closed near the high. But what we know is that if this market is making a counter trend and the bear trend is going to continue, as of the last bar in this chart, this market has reached the high probability retracement zone to complete a corrective rally at or near the 62% retracement, because the 62% retracement is within just 2 or 3 points of the 100% external alternate price projection. So we have some great information in advance, and we're at an area to which if we're long, to bring our stops very close to the market, or if we have our trend indications that the market is going to continue in a bear trend, that's a place to look to go short. Pop slightly above it the next day, down day, add data, and the market continued down pretty dramatically. So again, see how valuable this is on any market, any time frame. We put our retracements on, and if we have some nice clean swings to make internal alternate price projections, we do those. If not, we make our external alternate price projections. And we look at the last 1 or 2 or 3 corrections, and we make the alternate price projections to look and see where they fall, if one of them falls, near a retracement level. We do it all in advance, so we're prepared in advance for the high probability retracement zone to which we'll complete a correction. Let's look at another stock. How about IBM? Here's IBM, and it had this really sharp rally. It's making a decline, and let's assume that our trend analysis indicates that the decline is going to continue. Again, in future tutorials, we'll teach you about trend direction and momentum reversals and how we integrate price with other parts of our trading plan. Right now we're focusing on price and support and resistance. So if our trend analysis indicates that this bear trend is going to continue, we want to look for a retracement area that will complete one of the minor corrections, similar to one of the past minor corrections. Well, we first put our retracements on from the last high to the low in the chart. We can see the market's approaching the 50% retracement, but is it more than likely to make a corrective high near the 50, the 62, the 78.6%? Well, let's do the alternate price projection, or excuse me, the alternate external price projection by measuring the last correction, projecting it from the current low, and the 62% falls right near the 38%. We're already a retracement. We're already above that. Look where the 100% falls, right near the 62% retracement, not the 50, not the 78.6. The 62% falls above the retracement zone. So more than likely, if this market's making a correction, the ideal retracement area and the high probability retracement area to make a corrective high is right near the 62% retracement, because that's where the external alternate price projection fell. So we'll add some bars in the chart. Boy, it's hovering right around the 50%. Are we off on this? Well, let's see. The next bar poked right above the 50% or 62% retracement and 100% alternate price projection, closed mid-range. More than likely, as of that bar, IBM has completed a corrective high. So let me just clean the chart up a bit here. Right near that area, and we determined that area in advance. And that's the key, is that we're able to determine in advance which retracement area has the highest probability of being the support or resistance on a correction because it's the retracement area that's near the alternate price projection. So I'm going to add some data on this chart, and that was exactly the corrective high. Now remember, we did this in advance, and it's nothing complex. It's pretty simple. We do our retracements, our alternate price projections. We look to see what little zone near a retracement and alternate price projection falls, and more than likely that's going to terminate a correction within a trend. Let's go to, this is JP Morgan. Here's another market that was in a strong bear trend, but it was also making a pretty strong rally off the low on this chart. So if we anticipate that the bear trend is going to continue, is this market likely to make a corrective high near the 50%, 62, 78.6% retracement? Well, coming off of the low, the market went straight up. So once again, we don't have some nice, clean rallies and declines to make the internal alternate price projections from. So we go back and let's make an external alternate price projection by measuring the last corrective rally and projecting the alternate price projections from that rally. And I did the 62, 100, 162. We always focus on the 100% external alternate price projection. So I just took off the 62 and the 100. And once again, look where the 100% external alternate price projection fell. Well, it fell within a tick or two of the 62% retracement. So this market is just below the 50% retracement. More than likely, that's not going to be significant resistance. More than likely, it's going to be around the 62, and it's probably not going to continue to the 78.6%, because right around the 62% retracement is the symmetry and the 100% alternate price projection of the prior corrective rally. So let me clean the chart up a little bit here. And we've known in advance now that if this market, whoa, boy, look at that, it gapped up again. Gapped up and closed near the high of the day, right below our target, which is the high probability retracement zone to complete any corrective rally. And again, most traders are going to look at this and say, man, this market is just going up strongly every day. But if we're looking for a probable resistance zone, which the market will terminate this corrective rally, we've identified it in advance. Let's add a few more bars on the chart. It tagged the zone as of that next bar, a little inside day, we got a down day, and then it's strong down. Oops, so we went right back up. Look at that. We went right back up on the next day, big wide range day, right up to this retracement zone again. Another, we call this a snapback reversal day with a close in the lower half of the day. We'll add some more data. Market continued down sharply, down sharply. Big wide range up day. I'm going to keep adding some data to see if our resistance zone held, and it did. There we go. It continued to a new low. So we identified in advance that right around the 62% retracement was the high probability retracement to complete a corrective high within this bear trend. And we tested it once, and then about a week later, we came up, poked right above it, came right back down below it. And we knew that if this bear trend was going to continue, more than likely that's about the extreme of what the correction was going to be. So this works and is valuable on stocks, on futures, on intraday data, on daily data, on all time frames, on all markets, and it's so simple, so straightforward. I want to see you do this on all your charts, whatever time frame you trade, whatever market you trade. You'll be prepared in advance for which retracement is likely to be the end of a corrective rally in a bear trend or the end of a corrective decline in a bull trend. Works with all markets and all time frames.
Let's take a look at a short-term intraday example. What we're going to do is make both external and internal alternate price projections. We're going to identify which retracement level includes one of each alternate price projection. And we're going to quickly eliminate which retracements are not likely to be support resistance. Now remember, dynamic price analysis is a very important part of any trade strategy to identify in advance the end of a correction. Let's take a look at this example.
I'd like to do just one final example for you to wrap up this tutorial, and it's on 5-minute NASDAQ data. It's just from a day or two ago, and it was just one of those perfect setups. And again, when you're trading any sort of approach to your technical analysis and trading strategy, is you should wait for the ideal setups that have the highest probability outcome to take a trade. Now, every market, every time frame, every day may not have those ideal setups, but when they do, recognize them and take action. So the NASDAQ was had been in a bear trend, and we're looking for a high probability resistance zone that will complete a correction and continue the bear trend. So I'm going to first put my retracements on. So we have all the key retracements on from this last swing down. And now I'm going to do the external retracement, or excuse me, the external alternate price projection of the prior correction. So I'm going to measure the range of the prior correction and project the 100% alternate price projection. And that falls right near the 50% retracement. So more than likely, if this market is making a corrective rally, it's going to terminate that correction right near the 50% retracement. Not the 38, not the 62, not the 78.6%, but the 50%. But we have some nice internal structure here as well within the retracement range, and that we had a clearly defined rally, a nice correction, announced rally to a new high. So let's also do our internal retracements. So I'm going to measure from this first little rally and project the internal retracements, the 62, 100, 162. Now the 62 alternate price projection of this, not internal retracements, internal alternate price projections. I just erased the 62% alternate price projection because it was below where the market's trading. So look where the 100% is. It's just below the 100% external alternate price projection, which is right near the 50% retracement. So I'm just going to click off that 32% retracement. As we learned in the part 1 of this tutorial series, the 38% is rarely a key retracement zone for a correction except under a couple unique situations. So we have the 50% retracement has the 100% external alternate price projection, and right below it is the 100% internal alternate price projection. So we have a great zone right around 50% that has a high probability of completing a corrective rally coming off of this low, followed by the continuation of the bear trend, and we've identified it in advance. And we've identified it, we do these in real time, as these are just 5-minute bars. This is 5-minute NASDAQ. As the bars are added and we have made our prior swings, we can do our alternate price projections and our retracements. Well, I just want to point out that we can look at our DT oscillator, which is momentum, shows the momentum cycles, and we use it to help us identify highs and lows as well as our price analysis. It's in the overbought range, which is in the area from where typically highs are made and a continuation of the bear trend. So we have momentum in a position to make a high. As of the last bar in the chart, it's approaching our high probability retracement APP zone to complete a corrective high. Let's add some bars onto this chart. Went a little higher. As of the last bar in the chart, it popped up right above our retracement zone. Again, most people would think, most traders would think, oh, this is a very strong market because it went above the 50% retracement. But we know right in this zone is right where we have the high probability price target to complete a corrective high. And our momentum is also in the overbought zone. So what a great setup to initiate a short trade and any sort of short-term reversal indication. And boy, there we go. The next bar, big gap down right from this zone. And a bearish reversal in our momentum. More than likely, this bar has completed a corrective high, and this market is going to continue to decline to a new low. Boy, what great information. We had this information in advance. So we can do this on intraday trading. We can do it on swing trading. We can do it on a position trading. And you see how simple it is. Retracements we put on, but then we want to qualify out which retracement has the highest probability of being support or resistance, and we qualify that by the external and the internal alternate price projections. So keep these up on your charts, and you'll also be prepared for the high probability support resistance and trend reversal zones in advance, any market, any time frame.
In Dynamic Trader, we can also use one-click auto retracements and alternate price projections. We can save a lot of time using this approach because we preset all of our ratios, and then we click on one thing, and it actually shows us the retracements and price projections. We're not going to use this all the time, but once we have a formula that works, we can use it whenever we want. Let's take a look at that.
Well, before we wrap up the whole tutorial, I did want to show you one other function that's in the Dynamic Trader program that makes doing all these price projections even faster, even easier, even more accurately. And we call it the auto retracements and alternate price projections. For instance, rather than clicking on a low and a high when we do our retracements, we can simply make one click, and it doesn't even have to be exactly on the bar to instantly do all of the retracements. Now, the reason it doesn't have to be exactly on the bar is we have a swing file that's shown, and we have the program on what's called hot pivots. So whenever you're doing any of your time and price work, you don't have to hit the bar exactly in order to do the retracements or projections or alternate price or time projections, whichever. You can see we did it in one click, and they're all on the screen and with all the proper information. As far as doing alternate price projections, it's the same thing. It's one click. And we've built into the routine for it to identify the pivots, make the projections, and display whatever series of ratios you want on the chart all at one time. So once again, here the alternate price projections are all in red, gives the exact price, the exact ratio, cleanly and neatly shown on the chart. So that's just one way that at Dynamic Traders Group, for our Dynamic Trader software, we're always looking to make all of the functions, all the routines as quick and easy for the user as possible. And I think you can see how particularly this would be helpful for intraday traders who are using very short-term kind of data and maybe have several charts they want to quickly do their retracements and projections from. They can do them with our DT retracements, alternate price projections, auto routine. So I just wanted to show you that and appreciate once again you coming to our tutorial, and I'm so happy to be able to share this material with you, and I'm very excited about number 3 in our series. So I hope to see you then and to share some more information about real precision price targeting for the ends of trends and corrections. Well, in this tutorial you learned that retracements by themselves are not particularly valuable for practical trade strategies. You've learned how to use external alternate price projections to help identify in advance which particular retracement is most likely to be support, resistance, or trend reversal. And this is extremely valuable from a practical trade standpoint for any market in any time frame. So I want to encourage you, for whatever market you trade and whatever time frame you trade, be sure and put your retracements on and your external alternate price projections to identify those trend reversal target zones. Well, I'm Robert Miner, and thanks for joining us, and I look forward to sharing more of our information with our Dynamic Traders group in future tutorials. Thanks a lot, and good trading.
Well, thanks so much for joining us for this second part in our price tutorial series. In this tutorial, you learned about external alternate price projections. You learned how to identify in advance which retracements are likely to be support, resistance, or trend reversal with alternate price projections. You also learned that this is a totally objective approach to trading. There's no guessing. We take a look at it in advance, we set our stops, and we go. Well, I hope you'll join us for part 3 in this price series of tutorials, where we begin to talk about the mystery retracements, how we identify reversal targets in advance with external retracements. We're also going to look at how external retracements identify high probability price targets in advance for trend reversal. Well, I'm Chad James, CEO of Dynamic Traders Group. Thanks for joining us, and good trading.